Hi, this is Caleb. Welcome to Accounting 101. Now, in today's lesson, I'll cover with you the basics of double entry. Now, to begin with, let's look at what it means to do accounting. So we are looking at Accounting 101 today, and let's consider what happens when a business does accounting. Now, when we talk about accounting, we're really talking about the measurement of a business's financial performance. In your school, when I ask, how do I know your academic performance? Okay, when I ask about performance, we're really looking at what you call the report book of a business. Okay, the report book of the business consists of two financial statements. Okay, number one is your income statement, and the second is balance sheet. Now, we'll use this time to talk about the income statement first. There's only two things about income statement that you need to know. Okay, a business's income, okay, less the expense, you only have two results. Number one, you either pass, or in this case profit, or you fail or make a loss in this case. Now, how would the numbers look like? The main thing about the income statement, the first thing that students have confusion about would be the differentiation between income and profit. When I talk about income, right, the income of a business for, let's say, this year is 400,000. To generate this amount of income, okay, the expense is, let's say, 250,000. Then the profit will be 150,000. So when I talk about income, I'm talking about the 400,000, okay, and I'm not talking about profit. This is the main thing that you need to understand when we look at the income statement of a business, okay, to be able to differentiate between income and profit. Now, the second financial statement that you are tested in your syllabus is the balance sheet. So how will the balance sheet look like? Suppose I own a restaurant, and the restaurant consists of many assets. Okay, assets such as your kitchen equipment, assets such as your tables and chairs, your air conditioner. If this total assets is $100,000, how do we look at the business funding the setup? There's only two sources of funding. Okay, number one, it comes from the owner, which is what you call equity. Now, if Caleb only has $20,000 to start the restaurant, what does he need to do? He needs to borrow. And how much does he need to borrow if he only has $20,000 when the setup costs $100,000? Okay, he will need to borrow $80,000. This is what we call liabilities, and that's $80,000. So this gives you your first understanding of how the balance sheet works. Now, how does the balance sheet work on? Okay, the balance sheet work on the accounting equation, which is assets equals to equity plus liabilities. Okay, so basically the understanding is this: a business have an asset of $100,000. It will have to be funded by a combination of equity plus liability to pay for the total assets of $100,000. Next, we'll go on to understanding how accounting concepts affect the design and structure of the income statement and balance sheet.